Hello, welcome to Chapter 6 Handout, Key Calculations. In this handout, we're going to be looking at some of the key calculations that are discussed in the chapter and reinforced in this handout. The first one is book value. So in book value, the formula is rather simple. We take the total assets, we minus the total debt, and we minus the preferred stock, and we get our book value. So book value is basically equity, so assets minus liabilities. So total debt and preferred stock are considered liabilities, and assets are considered assets. So assets minus liabilities gives us our equity, which is another term for book value. Basically what this means is if the company were to close down and sell off all their assets and pay off all their debts, how much money would be left for you? So that's what book value entails. So generally, you want companies to have a book value because that would make the company more valuable. And some companies can have a negative book value. So if their liabilities are greater than their assets, they could have a negative book value, and that's generally bad. So book value is something that you would look at when you're evaluating a stock to get an idea of what type of value they hold. In some cases, if a stock has a book value that's higher, say a book value per share that's higher than their stock price, that would mean you could buy the company, sell off all the assets, and make a profit. Okay, so let's look at revenue per share. And this is another simple formula where we take the sales and we divide it by outstanding shares to give us an idea of revenue per share. And what's good about revenue per share is that if there's a stock price, you get an idea of the relationship of the stock price to the revenues per share. So if I buy one share of stock, how much revenue is attached to that? Because revenue is the starting point for profits. So if I buy a $10 stock and it's attached to $20 worth of revenue, that's a good thing because profits can be developed out of the revenue per share. If you have only $1 worth of revenue per share, the most profits you could ever have would be $1 per share. So that's why this is interesting to look at. And we generally like revenues to increase, so it's something that you could monitor and look at in a year-over-year basis. Okay. Now, book value per share, excuse me, so you have the total book value here. So the book value per share is just taking this book value, see how this book value number here equals this book value? I just copied that down. But we want to take our book value per share. To calculate our book value per share, we're going to take our book value and divide it by the amount of outstanding shares. And that gives us our book value per share. So if you wanted to look at your book value in relationship to your stock price, you get an idea of the percentage. So here, if the stock price was $12 and the book value per share is $9.37, you know that when you buy a share of stock, there's $9 of equity per share available to you. So it's another way of valuing the stock and seeing how they stack up compared to their competitors as far as their book value per share. And generally, you want a decent book value per share, but it shouldn't be greater than the stock price because that would signal a problem. Because stock price should always be trading above book value per share, and generally in a comfortable range of somewhere between book value per share be somewhere between 30% to all the way up to maybe 50% of the stock price. Anything outside that range would be a little suspect. Now the PE ratio is a very important ratio, and if we're going to calculate it, we just take the stock price divided by the earnings per share. So it's a multiple of earnings per share. So this company, PE of 20 means that the stock is trading at 20 times their earnings. And that's an important thing because if the PE gets too high, the company is considered overvalued because it's trading too many times their earnings. Just like if you think about it in basic terms, if you paid $25,000 for a pizza restaurant and it makes $100,000 in earnings, then that's really good. But if you buy a pizza place for $25,000 and it's only going to generate, say, $5,000 earnings, you'd be saying the PE is trading at 5. 25 divided by 5. Well, would it be? I guess what would be better is if you purchase something for $25,000 and you have $25,000 in profits, and the PE would be 1. So you see how a lower PE would actually denote value, and a higher PE. So if you had that same store, and instead of paying $25,000 for the store with $5,000 worth of profits, which is a PE of 5, what if you paid $50,000 for that store with a PE with the profits of 5,000? The PE is now 10 instead of 5. So the higher that PE multiple, the more value, the more you're paying for the company, the higher price you're paying for the company. So generally we like companies that have PEs lower than the market average. So if the market PE average is, say, 18, and you're looking at companies that are pretty well put together and they have a PE multiple of 15, then they could be considered undervalued or possibly a good investment. So that's why PE multiple is something you want to look at. Now, if a company has no earnings, you won't be able to divide the PE multiple. Or if the company has negative earnings, they really don't have a price multiple, either though you could calculate it, but it really would not be of any value. Okay. Earnings per share. So how do you calculate the EPS in this formula? Well, in earnings per share, we would take our net profits minus our preferred dividends, and we would divide that by the outstanding shares to get us. So this 49 cents here came from this formula. Profits minus preferred dividends divided by outstanding shares gives us our earnings per share. So, and again, a pretty simple formula. But earnings per share is very important because this is how much earnings is attached to one share of stock. So if I had two different stocks, if this stock was a $10 stock and this stock was a $10 stock, I would want to own this stock because it has higher earnings per share. And investors look at that, and that's when earnings per share increases, generally stock price increases. Okay, so let's look at dividend yield. So here again, we just take the dividend and divide by the market price, which is the stock price, and we get a yield of 5%. This is just, if you were, so whatever money that you put into the company, you buy at 40%, this is just saying you're getting a 5% return at the end of the year as a dividend. So it looks at the relationship of the stock price to the dividend they pay to give it a yield. And the higher the yield, the more percentage of your money you get back as a dividend. All right. If we look at market capitalization, here we take the outstanding shares and we multiply by the stock price. This is basically telling us what the total value of the company is. So if you want an idea, how much is Microsoft worth? How much is IBM worth? You just take the outstanding shares and you multiply it by the current stock price, and you get what's called the market capitalization, and it tells you what the total valuation of the company is, or how much it would cost you if you wanted to buy the entire company. And this is how we break stocks up into small cap, mid cap, and large cap. We look at the capitalizations to get an idea of how big the company is. Okay, dividend ratio payout. In this formula, we take the dividends per share and we divide by the earnings per share. And this gives us a percentage of our earnings we're paying as dividends. So here we're paying out 50% of our earnings as a dividend. And it just gives us an idea, if we're looking at similar stocks in the industry, how much do they pay out of their earnings as dividends? And for some industries like utilities, that's an important factor. Okay, so these are the key calculations that we reviewed from Chapter 6 that's part of this handout. Thank you, and I'll see you again soon.